Hi everyone, my name's Matt Barnes. I'm the lead trainer at Safety in the Market, and I'd like to welcome you to our 7-part series on FX trading. This is part 1, Introduction to the FX Markets. And if you haven't already subscribed to our channel, make sure you click on the subscribe button just below this video so that you'll be kept up to date with the rest of these videos as they're released, and also with our other great trading videos, which we release every week at Safety in the Market. So with that in mind, my goals for this 7-part series, firstly, I want to break down any barriers that you may have when it comes to trading FX. I've been teaching students for a long time, and a lot of students actually have mental barriers when it comes to FX. They think it's too hard or too complicated, or they won't be able to do it. In actual fact, it's no different to trading anything else. It's no harder than trading a stock or a share. It's quite straightforward once you know what you're doing. So I want to break those barriers down, and I want to give you the confidence and the tools that you're going to need to trade the FX markets with safety. So when I was learning, I went through 5 or 6 books on how to trade FX. I would read them, I'd try to work out what was going on, and it was a little bit of a struggle. Perhaps I wasn't a good student, perhaps they weren't good enough books, but at the end of the day, I just want to give you that confidence so you don't need to read another book on FX. You watch this series, I want you to have that confidence to walk away, execute a trade, and understand what you're doing and be comfortable with what you're doing at each stage of the game. So those are my goals for this series. So these days, I trade currencies exclusively. I've traded currencies since 2005. Initially, when I first was introduced to them, I was intimidated by them. I thought they were hard, but these days I trade them almost exclusively. So what does that tell you? It tells you that it's possible and that I think they're really good. Otherwise, I wouldn't trade them almost exclusively. I used to trade shares, and my plan was to then trade CFDs on shares, but somewhere along the way I got diverted and ended up trading currencies. And that's the journey that I'm going to be talking to you about in this introductory video. I trade the major currency pairs, as you can see there, the Aussie dollar against the US dollar, the euro against the US dollar, the pound against the US dollar against the Canadian dollar, and the US dollar against the Japanese yen. Now, as you look at that list, you'll probably notice a few things. Number one, all of these currencies are traded against the US dollar. As we'll discuss in part 2 of this series, whenever you're trading a currency, you're not just trading one currency. You're not just trading the Australian dollar like you are trading a share. You're trading the value of the currency, like the Australian dollar, against another currency. And when we talk about the major currency pairs, they always involve the US dollar. Okay, so that's the first thing. The second thing is that when it comes to major currency pairs, different people will tell you that different currencies are majors or not majors. So some will say that there are 4 majors or 6 majors or 8 majors. I was always told there were 6 majors when I was learning, so that's what stuck with me. And that was these 5 plus the US dollar against the Swiss franc. Now you don't see the US dollar Swiss franc on the list here. And the reason for that is I no longer trade the Swiss franc due to the volatility that happened a few years back with the peg to the euro. You can check out our other video on the euro against the Swiss franc on our YouTube channel for a little bit more information on that. It's an interesting story and a really valuable lesson there. So check that video out when you've got some time. All right. The other thing that I want to note here is that there are many more currency pairs that you can trade than this, and we will get into that in the next module. But for example, you can trade pretty much any currency against any other currency. So you could trade the Aussie dollar against the euro. You could trade the pound against the yen. You could trade the euro against the Canadian dollar. Whatever you like to trade, you can. The reason I only trade with 5 here is that with the amount of analysis that I do on a currency, I don't particularly feel like doing that on hundreds of currencies. And to be honest, you can't keep up with that level on every single currency. So I've chosen some currencies that are really good to trade, and every year they give me enough opportunities to trade for what I want to do, and that's enough for me. Some people will just trade one market and focus on it really closely. Some people will choose 2, some will choose 10, but at some point you'll reach a limit on what you can trade, and I'm happily trading those 5 currencies. Occasionally I'll take a trade on something else, but the bulk of my trading is done on these currency pairs. So very quickly, I want to show you the first FX chart that I ever saw, and this is the chart that sort of scared me off currencies a little bit. I just walked into a seminar. It was the first morning of a seminar. I was probably still waking up. It was quite an early start. And 2 things about this chart, when they brought it up on the screen and started going through a trade on this market, two things turned me off currencies. Number one, I saw that this chart traded to 4 decimal places, and having traded stocks all my life, I sort of thought, oh, 4 decimal places, how do I work that out? 1 point wasn't worth $1. It was an obscure amount. I thought, how am I ever going to work this out? So first I thought they were too hard, and that was an incorrect assumption. The second thing that turned me off here is I actually thought that they weren't that good for trading. If you take a look at the price scale, down in the bottom right, you can see 0.7. It looked like 70 cents, and up the top, that looks like $2. And I thought, this is just like a stock that trades between 70 cents and $2. And I thought, there's not going to be enough movement here for me to make money from. I'll just give these a miss and stick with shares. So they were my initial impressions. They were wrong, but they were my initial impressions there. And what I would say to you is, actually, currencies trend really well. And not only that, they tend to trend more frequently, that is, than other markets such as shares or commodities. Commodities will have stronger trends, but currencies will be trending more of the time. If you take a look at some commodity charts, you'll often see them going sideways for a number of years. All right. So looking at this chart over here, a movement from say at 1.8 up to 1.9, I thought that was like a 10-cent movement on a stock, but there's actually 1,000 price movements in there. So that's actually quite a wide range. And given that if you're a swing trader, you're probably looking at a 60 to 100 point risk at most on a swing trade. A 1,000-point move compared to a 60-point risk, that's a pretty good reward to risk ratio, even for a small move like this. So plenty of movement in the currencies, and they trend quite nicely when they do. All right. Now, moving on from there, we can see my first ever FX trade, and it was in late August of 2005. I've been trading shares for about 5 years up to this point. I was reasonably comfortable, with how shares moved. Obviously, with shares, I was only trading them to the long side, which means I was buying them and looking for them to go up in value. This actually doubled both as my first currency trade and as my first short trade, where I made money as the market fell. Basically, what happened is I opened up a CFD account intending to trade CFDs on shares, but because the markets were actually closed, it was the evening in Sydney time, so the Australian share market was closed. Because the markets were closed, I guess I had itchy fingers. I wanted to trade something, and I could either trade stocks on the London exchange, or I could trade currency. So isn't it funny? Twist of fate, I could have gone down and specialized in English stocks, but I ended up going down the currency route, and the rest is history. So I remember taking the trade. I thought, I'm going to click sell to open a short trade. I didn't think it would work. I didn't really understand short selling. I thought, geez, is this even possible? But I thought, you know what, I'll give it a try and I'll see what happens. One thing that I would say is that I did this with real live money, and I wouldn't recommend that anyone experiment with real live money. Brokers these days will offer you a demonstration or a demo account or a virtual account, they call them, where they put pretend money in, and you can experiment to your heart's content with pretend money. I guess one thing that I did right, I was intending to open a $30,000 account, but only deposited $500 first, just to make sure I did everything right. So I only had a small amount in there, but I put a trade on, and I thought I'd be risking about $50 on the trade. Turned out I was risking about $600. I found out later, so I had made a miscalculation. The net result of the trade, I'll always remember that, I made $250. I was up $260, but by the time I closed the trade, it got down to $250. And that all happened during the time it took for me to eat dinner. I put the trade on, I ate dinner, I came back and I'd had $250. I hadn't done it very well or done it correctly, and I look back on myself now quite harshly with that, but it was a learning curve. And what it did for me was a couple of things. Number one, it smashed through several mental barriers for me. Okay, so I had come home from that seminar thinking FX trading is hard, and I wasn't sure whether short selling was possible. But having taken that trade and closed it an hour later for a profit, I realized taking a currency trade was actually no harder than taking a share trade. I also realized that selling short and making money as the market falls is just as easy as going long and making money as the market goes up. And that's really important for traders as well, because markets don't go up all the time. They go up and they go down and they go sideways. So you've got to be able to take advantage of both markets moving up and markets moving down. I also learnt that it's possible to make money trading FX, obviously, from that. And I learnt that risk management is important. Um, I had thought I was risking $50. It turned out I was risking about $650. So you need to be on top of that, and we're going to be covering that in detail in the next couple of parts of this FX trading series. Finally, I also realized that education is important. There were things that I didn't know about the FX markets, and if I was going to trade them consistently, I needed to go away and learn a few things. All right, so they're the things that I learned, but the biggest one out of all of those, and the one that I think everyone should do as quickly as possible, is to smash through those mental barriers. Don't do it with real money as I did, but open a demo account, take a trade, and you'll see very quickly how it all works. All right, and I'm going to be taking you through that in these next few videos as well. Now, with that in mind, why do I actually trade FX? Well, there are a number of reasons. The first one, which I think is the most important, is the liquidity that you can get from the FX market. Literally trillions of dollars go through these markets every single day. And the fact that there are trillions of dollars going through them means nobody can actually control them. You can't, if you've got a tiny stock that's only worth $20 million or something, you could have a billionaire come in and bully that stock price around and push it up quite a bit and push it down quite a bit through the size of their buying orders or their selling orders. No one can do that in the FX markets. They're too large for that to happen. A lot of people like to have conspiracy theories. They say the government controls the price, or the central bank controls the price, or the Illuminati control the price, or computers control the price, but actually they're too large for anyone to manipulate. Someone can go in and dump some money in and try and push the price a little bit, but if it's not in sync with the trend of the market and what other participants in the market think, they're just going to get pushed back on. The market will just go back the other way. All right, and the reason being the liquidity in the markets, there's too many participants for that to happen for any one person or any one institution to control the market. So let's have a look at the participants in the market, or some of the participants in the FX markets. So firstly, you've got the central banks. So they're bankers to the government. So when the governments come out and decide they're going to spend X amount of money, the central bank plays a big part in that happening. Central banks can also come in to buy and sell the currency of a country, of their own country, if they want to try and stabilize it, if they think it's gone too low or too high. Okay, so you've got the central banks in there, and people like to listen to what the central banks have to say and look at what they're doing, but don't be sucked into thinking that the central banks can control a currency. In part 6 of this series, we're going to look at an example where a central bank did everything they possibly could to control a currency and failed miserably. Okay, so central banks, they're a big participant, but they're only one participant in the FX markets. Another participant are importers and exporters. So let's say you live in Australia and you dig resources out of the ground and ship them off overseas. Those resources are going to need to be paid for, presumably in Australian dollars, which means that people in other countries who are buying the product that you're exporting are going to have to convert their currency into Australian dollars for you to be paid. So there's a transaction that happens there, and that happens in the FX market. So that's going to affect the currency. Okay. You also think about importers, people bringing stuff into the country. We're importers. If you've ever shopped online, you're an importer. If you buy something, say from Amazon, and you have it shipped to Australia, there are two currencies there. There's the local currency that you're dealing with, and the US dollar that the sale goes through in. So importers and exporters are going to affect the FX market. You've got overseas travelers, probably not as big as all of the other ones, but still important. You've got people traveling overseas to all sorts of countries every day of the week. There's money changing hands there at particular rates as people convert their local currency into an overseas currency. That goes through the FX markets. You've got investors buying and selling shares. So if you wanted to buy or sell shares, say in America or Europe or England, for example, there's a currency exchange between your local currency and the currency of the shares that you want to buy in. Finally, you've also got speculators, presumably like you and certainly like me, speculators who don't really care about, or we're not importing or exporting anything. We're not traveling, we're not investing as such, but we're wanting to profit from price movements in the currency. So if we see the euro, for example, and the price of the euro is going down, if the euro is trending down, We want to jump on board that trend and ride that trend down and make some money with it. So you've got speculators, and these days probably more speculators than ever, because it's so easy to get involved. It's so easy for anyone to open a trading account. In the FX markets, you've got leverage typically of 0.5% to 1%. So a $5,000 deposit will let you control 1 million Australian dollars against the US dollar. So it doesn't take much money to take a reasonably large position there, but that's still going to be dwarfed by all of the other money that's in there. So loads of participants. A central bank can try to control a currency, but they're not going to be able to do that, at least not for a very long time. They might do it for a few minutes or a couple of hours at best. That's about as bad as I've seen it. So why do I trade FX then? I love the fact that it's a 24-hour market, Monday to Friday. That's not because I love to sit and watch and be glued to the screen for 24 hours a day, but it means that there's no gapping or slippage, which I'm going to talk about in a moment. It also means you can take a trade at any point. So if you decide you want to get out of a position for whatever reason, you can jump out whenever you like. You don't have to wait for the stock market to open the next day, as you would if you're trading stocks. The reason that FX is a 24-hour market is that there's no one single exchange. Like the Australian Stock Exchange is open from 10 a.m. till 4 p.m. Sydney time. So you've got 6 hours a day, and all the share trades all go through that one exchange. Well, FX is not like that. FX is dealt between banks on a global basis, and it happens all around the world. So you've got banks open all the way through the day. In the morning, in Australia anyway, the morning and during the day, you have what's called the Asian session, which is where you've got the Australian banks, New Zealand, Hong Kong, Singapore, Japan, etc. You've got the European session in the afternoon, where you've got London, and all the European banks opening up. And then in Australia, in the nighttime, you've got the US session where the US banks come online. And each of those sessions overlaps with the previous session and again with the session after it. So there'll be a time where you've got a little bit of the Asian session and the European session crossing over later in the afternoon in Sydney time. And then later in the evening, you've got the European session crossing over with the US session. And then in the early hours of the morning, in Sydney anyway, you've got the US session overlapping with the Asian session. So it's a market that trades around the clock, and all of those sessions are highly liquid. So it doesn't matter. They say that the US session is the most liquid. I guess it depends what currency you're trading, but they're all highly liquid. You're not going to have any problems trading them. And the benefit of a highly liquid market, massive benefits, but the two biggest ones are, number one, there's usually no slippage when you're trading the majors and with most of the minors as well. We'll talk about majors and minors in the coming lessons, but no slippage, which I'll define in a moment, and no price gapping. So when I say no slippage, imagine you're trading a share, and most of you, if you've traded shares, you've probably come across this at one stage or another. A share that you want to buy is trading at $25. So you put an order into your broker and you say, buy me 25 shares at market. And you think, sorry, buy me 1,000 shares at market, and the price is at $25. Then you get a slip back from your broker that says, yep, I bought you 1,000 shares, but I bought 300 at $25, and then I bought another 400 at $25.01, and then another 300 at $25.02. And you say, but hang on, the market price was $25, but slippage happens when there's not enough buyers or sellers to fill your order all at the one price. Okay, that's because not enough people are there in the market prepared to buy or sell at the price that you want to trade at. And that happens in stocks. I can't remember the last time that's happened to me on a currency. It just doesn't really happen, okay? Because there's so much liquidity in there. There's so much money at any one time, you get your orders all filled without any slippage. So that's a really big advantage in itself. But the one that I really like, see, I don't mind a point or two of slippage. The one that I really am afraid of is a price gap. And I've never had a price gap trading the currencies in all these years, okay? 13 plus years of trading currencies, never had a price gap against me, all right? Now, what is a price gap, you might ask? That's a price gap. Cast your mind back a few months. You can see this is a stock chart of Facebook, which trades in America. And you can see there a price gap is where the market closes at one price and then opens up the next day at a different price. And the reason that something like that happens is that some news or some kind of event has occurred while the market has been closed that's caused traders to reassess what they think that market is worth, right? So in this case on Facebook, Facebook closed in the middle of July. It closed one day at $217.50 and it opened the next morning all the way down at $174. Now, imagine you own 1,000 Facebook shares. $217,000 is your investment value when you go to bed, and $175,000 when you wake up. That's a pretty steep fall. Okay, a very steep fall. That kind of price gapping just doesn't happen on the FX markets. The only time it can happen on the FX markets is if something happens over the weekend. Okay, if something occurs over the weekend. But as I said, I can't think of an example where I've been gapped in an FX trade. I've been gapped in stock trades before, but never in an FX trade. I'll talk a little bit more about gapping shortly, but just know that there is that benefit in trading a liquid market like FX, having no slippage, having no gapping. It just gives you more peace of mind in your trading. And in terms of the slippage, it gives you better entries and exits as well. So why do I trade FX? Obviously, there's the liquidity, there's the fact it's a 24-hour market, but I also love the fact that currencies trend really well. David Bowden, who's the founder of Safety in the Market, David said, if I could only trade one thing, it would be a currency. Now, you might think, so what? Well, David was famous throughout his trading career for the calls or the forecasts that he made on the Australian share price index. All right, now he traded the Australian share price index, but he also traded currencies. He had his fame coming from the share price index, but he still said, if he could only, and he loved trading the share price index, but he said if he could only trade one thing, it would be a currency, because currencies trend well. So they give you more opportunities to profit from the market. David's price forecasting lessons, by the way, if you've got the Active Trader program, David's price forecasting lessons work really, really well on the currencies because of their consistency, their consistent trends, and the consistent ranges that they make. So again, more reasons there for trading FX. Now, with that in mind, if we've established FX as it's a good market to trade, how can we go about and trade FX? Well, there's a few ways that you can do it, but there's only one way that I do it. One way that you could do it is, if you think about it, just to give you an example of how this all works, you could go to the dealers that you see at the airport. When you're about to catch a plane and you've got the booths and they've got all the currency prices there, and you can just take some money out of your wallet or out of an ATM, go over to the dealer, and they'll exchange it for you into a foreign currency. That you're actually trading, taking an FX trade. You're trading one currency for another there, and that money will go through the FX market at some stage as the dealer manages their cash flow there. But what actually happens there is that airport dealers, they're not a charity. They want to make money. So I'm sure you've seen the wide spreads that they offer. In the FX markets, you'll see a spread of one tick or less at most times in the FX markets, whereas airport dealers, they might have a few cents, which is a few hundred ticks. So you lose money straight away. As soon as you exchange some money with an airport dealer, you lose money, because that's how they stay in business. That they have to make money. They're not, as I said, they're not a charity. So airport dealers, that's one way of betting or making money on a currency movement, or profiting from a movement in a currency, but it's not a good way. A better way is to go straight through the foreign exchange markets or the FX markets. And these days, there's plenty of FX brokers out there. It's really easy to open up an account and get yourself started. Most brokers are fairly similar these days. Back in the day, there used to be some really good brokers and some really not so good brokers, but these days they're all fairly similar. From what I can tell when I go through and have a look at them, you'll see that a lot of them have very similar trading platforms. So the suggestion I'd make is just open 3 or 4 demo accounts with different brokers and get a feel for their platforms and see which one you like, because at the end of the day, they're all going to be fairly similar in terms of the pricing and what they can offer you. All right, so that's the way that I trade FX. There's a couple of other ways that you can trade FX. One is by using options. You can trade options on stocks. You can trade options on FX. The last time I looked, FX options weren't as liquid as you might perhaps like them to be. Certainly not as liquid as the actual FX markets. But if you wanted to trade the FX markets using options, there is that extra element of safety there. If you're a skilled options trader, perhaps you'd like to do that. Another way of trading FX is through currency futures. And if you've got the active trader program, you can check out Appendix B of the Smarter Starter Pack, and that'll tell you everything that you need to know about trading futures. A lot of people ask me which is better to trade, FX or futures, and there's two reasons that I'll give you that I trade FX rather than futures. Now, if you ask me which one is better, I can honestly say both have their pros and their cons. Okay, so it's not really a case of one or the other. It's what works for you or what you prefer. As I said, I prefer FX for two reasons. Number one, which is key, is the flexible position sizing. Okay, if you've ever read any of Van Tharp's work, Van Tharp talks a lot about trading psychology and risk management, and he talks about risk multiples and risking the same dollar amount on your trades or managing that risk size. Let's say you want to risk $500 exactly on every trade that you want to take, or as close to $500 as possible. You'd have to set your position size according to your risk. Now, if you're taking an FX position, you've got very flexible position sizing. It moves in $10,000 increments. But if you're trading a futures contract, you've got a deal in the minimum position size that the futures market gives you. So if you're trading the Australian dollar futures, for example, you can trade $100,000 at a time, or $200,000, or $300,000, or $400,000, or in $100,000 increments. You can't trade $220,000 or $240,000 or $250,000. Now you might think, so what? Once you're a big enough trader, that doesn't matter anymore, but it does matter because your risk is going to be different. You might want to risk $500 on a trade, but you might go into the futures market and realize if I take one contract, I'm risking $350. If I take two contracts, I'm risking $700. But I don't want to risk $350. I don't want to risk $700. I want to risk $500. So with futures, it's a little bit harder to tighten up the risk on your positions and have them as close to the same amount as possible. Whereas in the FX market, you can do that much more closely because you've got those $10,000 increments to play with. All right. Some FX brokers will even let you trade in $1,000 increments. So you can get that risk even tighter there. All right. Now, that's important to me. Perhaps you're a little bit less strict on that. That's fine. But there is a second reason that I prefer the FX market over the futures market, and that's because of the 24-hour trading day. The futures markets close for 1 hour each day. Now you might think, oh, 1 hour each day, what can happen in 1 hour? Well, a lot can happen in 1 hour. Think about the world that we live in. Think about the dramas that could unfold at any point. I'm not trying to be alarmist here. I'm just trying to make you realize the value of that extra hours trading. And I'll show you an example of what I mean in a moment. But think about the dramas that could unfold at any point. Think about what's going on in 2018. You've got President Donald Trump, tweeting his commentary on pretty much everything he feels like. You've got, which is fairly unprecedented. You've got a trade war unfolding between the US and China. You've got tensions from earlier in the year with North Korea and the United States. So there's a number of things. If something blows up, if there's a big event or a big trigger, markets are going to panic and markets are going to start moving. Now, if you're trading a market like a futures contract that is actually closed while that news occurs, when it reopens, it's going to gap when it opens to catch up. And that's why I like the 24-hour trading day, because the market's not going to gap. It's going to trade through there. So I'll give you an example of where this has happened quite recently at time of recording. Here's a futures market gap in the middle of the week on the Euro futures. So this was the 13th of September 2018. The Euro closed at 1.1692 on the 13th of September, and then it opened at 1.1775 on Friday the 14th of September. Now, this is a chart from Profit Source Software by Hub Financial Group, and this is a bar chart. If you're not sure what a bar chart is, there are four key points to pay attention to here. Firstly, you've got the high of the bar. So you've got a vertical line here. The high of the bar, that's the highest price that the euro traded during this trading day. Then you've got the low of the bar. That's the lowest price the euro traded at. You've got a little dash to the left. that's where the euro opened on that day, and then you've got a little dash to the right. That's where the euro closed on that particular day. Okay, now on this particular day, on the 13th of September, the euro closed here at 1.1692, and it opened 1 hour later at 1.1775. That's a gap up of 83 ticks. Now, you might think 83 ticks isn't that much, but on a single futures contract, that's 1,000 US dollars right there. Now, if you were short, you were trying to make money as the market goes down here, and the market gaps up against you, there's nothing you can do. You cop $1,000 loss there for every contract that you hold. If you're holding 10 contracts, which is not a large position, by the way, if you're holding 10 contracts, there's 10 grand gone like that. Okay, and there's nothing you can do about it. If you've got a stop loss that's sitting behind this high here, okay, the market has gone through there, but it's actually opened past there. So you don't get out at your stop loss, you get out where the market opens. So as you can see, I really don't like gaps. Some people are a bit more comfortable with them and they say, oh, it's just a part of trading, I'll accept them. But I say, why accept them? You've got the FX markets. You can see here's the same chart, the euro against the US dollar, but this is the same market in the FX market rather than futures. Here's what the FX chart did. It closed on the 13th of September at 1.1688, and it opened on the 14th of September at 1.1688. Okay, no gap there. How can this happen? Because it's a 24-hour market. The closing price that you see on this chart, it's not really a close, it's a timestamp. Because it's a 24-hour market, the end of one day is exactly the same time as the beginning of the next day. All right, but you can see there the gap didn't occur there on this chart. In the FX market, the market closed at one price, opened at the next one, so there's no gap there. Now, as I said, gaps are really rare. That one on the futures was still quite rare, okay, but it can happen. It only takes one little tweet or one little major event, or markets seem to be more and more easily spooked these days, with the speed of the 24-hour news cycle. It doesn't take long for people to panic and react and, trade first and ask questions later. So, as we get further and further into this technological age, I think trading a market like the FX market where there are no gaps makes more and more sense. At least it does to me. All right. So that's been an introduction to the FX markets, just to give you a little bit of a taste for the sorts of things that we're looking at and how you can trade the FX markets, who the participants are, why I trade FX. Coming up next, we're really going to get stuck into the meat of things. We're going to look at all of the components of an FX trade. So everything from your position size, the tick size, the tick value, how much your trade is going to be worth, how much margin you have to put up, how much interest is involved, all the little nitty-gritty stuff. We're going to get into that in part 2. Then in part 3, we're actually going to look at taking an actual FX trade. I'm going to open up a demonstration platform and I'm going to take a trade. With the markets open, with the markets moving, I'm going to take a trade and you're going to see how it all unfolds and see what it looks like. Then in part 4, we're going to look at account management and position sizing in the FX markets. So by that stage, you'll be able to take a trade, but you have to look at how big a trade you take, and the fact that just because you can take a large position doesn't mean that you should take a big position. All right. Part 5 is actually going to be too big for one video, so I've split it in 2, but they'll both be released at the same time. It's all about currency analysis. So how do we analyze a currency and work out which way it's going? And there are 2 main schools of thought there. Many of you would be familiar with these. One is fundamental analysis, and the other is technical analysis. I'm predominantly a technical trader, but I'm going to take you through both of those. In part 6, this is actually one of my favorite parts where we look at lessons from history. If you watch any of the financial news channels or read any of the financial news websites or papers, you'll notice they all have a common theme, and that's that they're all heavily focused on what's happening right now in the markets. And there's a bit of a scurry for who can be the most up to date and who can scoop a piece of news and who can announce something first. And whenever an announcement comes out, they're all glued to the screen, and they have to know right now what's going on. And I think it's a shame because there are a lot of lessons that you can learn by taking a wider view and looking back over the history of the last 5 years, 10 years, 20 years, 100 years, looking back at how markets work. Human beings, technology and the things that we can do have changed a lot, but humans haven't changed all that much, or we certainly haven't changed as much as we think we have. And if you look back at previous market bubbles, previous market booms, and previous market busts, you'll see that there are a lot of common factors there. And there's a lot of lessons we can take from history and from various case studies. Okay, so in part 6, I'm going to look at some of those lessons that we can learn from history so that when they happen again, we can learn from them rather than being surprised by them. The final part, in part 7, we're going to be setting up for an FX trade. So we'll have come full circle, we'll have been through everything, all the components of an FX trade, we'll have taken trades, we'll have spoken about account management, position sizing, how we analyze, we'll have learnt some lessons from history, and we're then going to set up for an FX trade using a case study where we see a real-time chart and we say, what's the market doing here? How are we going to take a trade? Which way is it likely to go? How are we going to enter it? How much are we going to buy or sell? How are we going to manage that? We're going to do all of that in that final module. Okay, but each module builds on the module that comes before it, so make sure you watch these in order. And as I said earlier, if you haven't already done so, just please click on the subscribe button below this video so that you'll be kept up to date as these videos are released and as all our future videos are released on the Safety in the Market channel. All right, so that's it for part 1. I hope you've enjoyed that. I'm looking forward to chatting with you in part 2, components of an FX trade. Thanks for watching. I'll see you next time.